Welcome, Bruins, to Viewpoints from Bruin Founders and Investors. For today's session, our panel will be exploring the topic of evaluating startup opportunities. My name is Gloria Ko, and I serve as Senior Director of Alumni Career Engagement at UCLA Alumni Association. I'll be serving as your moderator today. And so first, I want to thank our sustaining donors of our Alumni Association that help make our programming possible for our alumni. So thank you to those who contribute to support our programs. I also want to thank Alumni Ventures and Westwood Ventures, who are presenting sponsors for today's webinar. So we're really excited to work with them on this program. Our session is being recorded and will be made available on our UCLA Alumni YouTube channel soon. So check out the link and look out for the recorded video there. We will have a great panel discussion. We have a lot of great insight for you today. And after our panel, we will have time for Q&A. So be sure to add any questions that you may have in the Q&A function below and not the chat, just so we have all the questions there. And also, if you want to direct a question to a specific panelist, please be sure to add the name of the panelist in the question so we can make sure we're addressing the right person. So be sure to add that in as well. And so now let me introduce our panelists for today. First, we have Stella Ashaolu. Stella is a UCLA graduate from the class of 2008 with a degree in political science. She is the CEO and founder of WeSolv, a platform connecting companies to more diverse candidates and leveraging performance data from real projects to reduce hiring bias. She is also the co-founder of Fifth Star Funds, an evergreen philanthropic venture fund investing in Black founders at the friends and family stage. With years of management consulting, big data, and predictive analytics experience, Stella brings her lived experience to building a research and data-based technology solution to improve diversity hiring for enterprise customers, such as Salesforce, Pinterest, and Discover, and has a network of over 30,000 diverse business candidates. In addition to serving as a Techstars alumni mentor and an 1871 mentor, Stella is a vocal leader and diversity advocate in the Chicago tech ecosystem. Our next panelist is Trish Halamandaris. Trish returned to UCLA Anderson in 2017 as the director of the Venture Accelerator at UCLA Anderson to initiate and build the program. The Accelerator operates 3 curated year-round programs for early-stage startups to translate their entrepreneurial visions into innovative solutions. The program is running at an 85% success rate, having supported 165 companies to date with 6 exits, $176 million in venture funding, and $67 million in sales. Trish is an award-winning chief marketing officer and has launched several #1 products at Disney, Electronic Arts, and Procter & Gamble. And prior to returning to UCLA Anderson, she was the head of cloud marketing for Amazon Games and was CMO for XPRIZE. She earned a BS in finance and accounting from the Haas School of Business at University of California, Berkeley, and her MBA in marketing and finance from UCLA Anderson. Our third panelist is Phillip, who is a UC alumnus with a degree in cognitive science from Berkeley. Phillip is a co-founder of Gen G Esports and currently sits on the board. Presently, he runs a hardware company called Gamevice, of which they have sold over 1 million units and launched their last product in partnership with Razer called the Kishi. Prior to Gen G and Gamevice, he sold a software as a service company, Enterprise Technology Group, to Nexstar and ran it for several years post-acquisition with clients such as Fox, Tegna, Hearst Scripps, and Graham Media. And prior to ETG, Phillip founded and operated companies that have provided global technology and marketing services to companies such as Fox Sports, NBA US and China, Tom Group, LG Electronics, and Hyundai Motors. He is also an early investor and advisor to Kabam and Ardius, and currently sits on the board of Hispanic Scholarship Fund and the virtual reality company Boulevard. Our final panelist is Edward Tsai, who received a bachelor's and master's from UCLA. Ed has more than 15 years of investment experience in the US and China, including a successful track record with investments such as Cruise Automation, Life 360, Palantir, and Brave Software. He has served on the limited partner advisory committees at Kendana Capital and 1011 Ventures, and he has deep operating experience at tech and cybersecurity companies. Most recently, he was director of investments at enterprise security company Changqing, where he led $700 million in fundraising, ran multiple M&A deals, and managed a large investment portfolio. So welcome to all of our panelists. I'm going to have them join us on screen, and we are going to start our conversation today. So welcome to all of our amazing panelists. And if I did anything, you want to add anything or edit anything I said in your bios, please feel free. And for our session today, we're talking about this topic of evaluating a startup and the opportunities they can provide. We're looking at two vantage points: from the investor side, from what they look at when they're evaluating a startup, and then also from the side of a founder, and also those who are working in a startup. So some of you may be new to the startup space, thinking about whether you want to even join a current startup or even start your own. And so we're going to be addressing some of these different points throughout this panel. And as I have shared, all of our panelists has really deep experience, whether that is on the company side or on the investment side. And so please feel free to address, but I will direct some of our questions that are particular to their experiences as well. So in our three areas of evaluation, we're looking at three, which is the team. So whether that's the founders, those that are starting the company, the business in the marketplace. So looking at the competitive edge and what they're bringing to the landscape. And then also the lifestyle and culture fit of a startup company. I think for some people, they think, oh, it's just like any company, but being in a startup, there is a different feel to your day-to-day. And so for those of you that work very closely with startups in them and also supporting them, we'll also learn from your experience as well to share with our listeners today about that. And so again, please do add any of your questions into the Q&A. We will try to go through our questions and then come to them at the end. So we'll get started. So my first question is actually for Ed. So he'll start us off. As an investor, what are traits that you see in successful founders? Are there common characteristics for the most successful startups and founders you've invested in?
Yeah, I'd say, for some of the successful founders that I've backed, I think one is sector knowledge. So are they doing something they're familiar with? If that means they're, the new company that they're doing is in the real estate industry, did they work at companies like Zillow or Redfin? If they're in cybersecurity, do they work at winners like Palo Alto Networks or CrowdStrike? I usually also like to see someone who has some product experience, either as a PM or in tech, just because for new companies, you're offering something new. So as an entrepreneur, you need to have some product vision. And so if you've developed a product and it's seen the market, it's gone at scale, I think that's very helpful. If I were to say a third, I'd say someone who has both confidence but also humility, so a good self-awareness. I think when we ask questions during the pitch, if the person's very aware of the other competitors in the market, the pluses and minuses about their approach or kind of challenges seen by other companies, then I feel they're really realistic. If I say like, hey, where other companies are like, no one's a competitor, and I'm like listing out like 3 or 4, if they haven't heard of them, I feel like they're not really serious with doing due diligence, or I have heard of them, but they're not willing to acknowledge that or acknowledge some challenges or even strengths of the competitors. I feel they're not being as realistic. So I think those are some of the key either background or characteristics of successful founders.
Great. And for Trish, are there behaviors and signs that founders show that could lead to trouble or some problems down the line? Have you seen some common mistakes or red flags in your early stage startups?
Yeah, definitely. I think, we kind of look at this in 2 ways. One is the actual business itself, and then the other is the person. And what Ed was just saying, I'll lean into that, which is really the founder themselves. We always just call it the coachability. If you're starting at an early stage, like we support, you're going to have many advisors and mentors and people who have helped you along the way. And that's really key, I think, to helping a founder and a company scale at the early stage. I think a difficulty on that is that sometimes you get contradictory advice. So where Ed was saying, if they have sector experience or some prior business knowledge, that helps because it helps them faster process which advice they want to take forward. So that's the person. And then the business itself, really at the early stages, there's two key things that we see consistently if somebody's going to go sideways. One is they either haven't properly defined the product market fit, or they don't have capital. And up until now, capital's been pretty easy to flow, thanks Ed, until assuming you've got product market fit. And those are some of the things Ed was talking about. You know, who's the primary audience? Do they have even beta clients who aren't paying, but they have repeat customers? Have they properly defined competition? We see this a lot negatively at this stage where, you know, could you do a perceptual map? Have they identified? Often we'll get, we don't have any competition. You know, I know everybody has competition. So even if it's not direct, there's tangential competition to be aware of market trends, global, what's happening, and some of those things. So it's really, you know, that awareness and that bringing the person's whole self to the table and being humble and then ready to hustle. That grit, I know those are generic, but I think those are, you know, do you have it? Do you have grit? Do you have hustle? How much do you want it? How much do you think your product is needed? You know, some of those intangibles we look for.
Great. And, you know, now we also have two founders and those who started companies on this panel. For Phillip, as a founder, you know, let's say you're ready, you got the hustle, you've got the fit, you're ready to go. But then how do you determine your team and those that you work with? Because you probably can't do it all by yourself. How do you, you know, what attributes do you look for in those that you work with to help bring something to life?
Yeah, I would, you know, I think one thing from a character point of view, I would tell and talk to my team about all the time, whether, you know, we were still trying to be entrepreneur when we were at a public company, but we're at 2 employees, the same thing. I give you an example. My very first startup, I launched a fantasy sports game with the NBA in China in 3 months to 700,000 users, remotely, deployed out of Los Angeles, California, coded by 2 people, supporting 700,000 users. And like, you know, there's a lot of risk because you're going to throw it out into the wild. It's got a big brand name to it. And what I try to tell a lot of folks is, you know, you don't have to be perfect. You just have to keep moving forward. It's not going to go perfect. Were there problems? Yes. Were there issues? And at that time, there's a whole bunch of other technical problems. But it's really important that you have the perseverance to actually keep moving forward and not get hung up on the fact that there's going to be problems. There's always going to be problems in a startup. Things are always going to go bad. And so there's a little bit of like risk tolerance that you have to look for in character traits from other co-founders, because if they get really discouraged or they have to be a perfectionist, because speed is your biggest ally. And if you get caught up in a lot of these details or small failures or problems that seem to be never ending, it's just not going to be cut out for here, right? I think the bigger companies are the ones who are going to take less risk, make sure things are really buttoned up and polished, versus in the startup world, if you kind of got 80% of the product, you sort of throw it out in the wild, see what comes back, and then you just keep going, right? And I say it's never going to be a straight line. It's going to be a jagged line, but as long as you're moving in the directionally correct, you know, you really should be okay. So that's one of the big things. I think the second thing for me would really be finding someone who complements a skill set that I do not have, and one who's willing to learn. I think those are 2 just absolute must traits, because you are going to overlap in some skill sets, which is also good because you want a healthy sort of balance of arguing and being able to discuss things. But having expertise in particular areas that you don't have, and then, you know, the second thing is going to be if that person is unwilling to learn, it is very hard to move forward, and it's very hard to move quickly, and it's very difficult to do something very efficiently. You know, when your team is small, you move very quickly because you have very few people making all of the decisions. And that's where, you know, in the very, very early starts, you can move at lightning speed, is because of that, versus when you start scaling and having a lot more employees, the decision making is actually spread out across more people.
Thanks, Phil. This is a question for Stella. As the founder of WeSolv, what impact can a great team member really make on your company at this stage? And then also, what can a bad team member or someone, may have on your team currently?
Yeah, that's a really great question. So I'm a solo founder. So for me, it was really critical in the early stages to find people who could support me in building the vision that I had for WeSolv. And unfortunately, it wasn't as easy as, my college roommate or my business school friend, was interested in the same thing. And so we set out to start this. It was a very intentional search. And honestly, telling anyone and everyone who would listen to what I was trying to build, and seeing who was interested and who had, to Phillip's point, complementary skill sets, that was really, I think, really important for me finding my first head of product who partnered with me to build this platform, and was really essential in supporting me as a solo founder, where you're kind of beating your head against the wall because every decision, from the color of a certain button to really crucial decisions, are being made by you. You need somebody who can take ownership of their respective area and take that forward and do it better than you can. But at the same time, bringing someone on your team, which I have made the mistake, that wasn't the right person for the role or the fit, can be really problematic. And you'll hear the saying, hire slow, fire fast. It's a lot easier said than done when you really need a job to be done really quickly. And when you are emotionally invested in the people on your team, it's hard to make those decisions. But what I had to learn the hard way is that when there's somebody on your team who's not helping the team move forward, whether it's from an execution standpoint or culture standpoint, they are not only having effects on the area that they're responsible for, they're having effects on the rest of the team. And the team is looking at you as a leader to see how you address that. And when you reward, a level of performance or certain behaviors that you don't want others to exemplify, that becomes a problem. And so they'll look to you to see how you handle that. And sometimes it's uncomfortable. The worst thing that I've ever had to do as a founder is let someone go or let folks go. But it's important for the health of the business and for everyone else who remains, who's trying to build that.
Great, thank you. In terms of, I know there's a lot out there about, founders and what a founder is like and all this stuff, but in all of your experience, this is my question to all of you, is like, what has been maybe someone that you like in terms of behavior that was like you have all said things of like their willingness to listen and all of this. What has been, again, another like hallmark of like good behavior, and then also, as we're saying, like this will kill this is a great idea, but this person and this kind of characters will not thrive, even no matter how good the idea is.
I can start from my own personal experience and also from my experience with Fitstar Funds. I think the biggest thing is just kind of a hunger to learn. When you become a founder, you have to be humble enough to know that you don't know a lot and that there's so much to learn, but you have to be excited about that journey. That has to keep you up. You have to go to sleep thinking about, this, and wake up thinking about it, and not in an unhealthy, kind of, you can't do anything else way, but you're just so interested and it naturally comes to you that you just want to learn more about that industry, about your customers, about the solution, about the ways to be more efficient. And you are humble enough to go and seek out that information from all different sources.
Phil?
I would say, one thing that I hear a lot, and I see this a lot for founders who are unable to stay in their position when they scale a business, is making quick decisions. I think every person has a different way in which they can get to a point where they know how to make the decision. It's sort of like everyone has a different process they go through to choose what kind of car they want to buy, right? But imagine the car was something no one understood or know. How do you go about making that decision for all sorts of decisions you need to make? Color, do you want speed, power, whatever it's going to be. And so you have to sort of learn how to Stella's point, learn enough for you to make a decision and make it very quickly, and then just stick with it. Indecision will essentially kill you because speed is, you're supposed to be your biggest asset as a startup. And so your inability to make a decision or not knowing how to make the right decision that is directionally correct, again, not perfect, I think is also just very detrimental to the team, because as the leader, that is sort of your responsibility. And it comes down to, how much money do you want to spend on this? Who makes that decision? And when there's a lot of risk at play, most people aren't comfortable making it. But as a founder, you got to make it. And you got to feel pretty confident about how you come to those decisions and do it very quickly.
And
Yeah, I would add two things. To Philip's point, I think similar to making decisions is the willingness or ability to pivot. Now, I don't mean pivoting all the time, like you shouldn't like just change all direction all the time, but I've seen some good startups, like they're willing to acknowledge when something's not working. Like some people just keep on going and they burn all the cash and you have no room to pivot. But other companies are like, hey, I'm working on this 3 months or 6 months. It's really not working. Let's, customers don't really like it. But hey, we did something else that a lot of other people could like or like to use. And so I think that willingness to pivot, and sometimes, it's not easy to do that because it's like, hey, you create a product, it's kind of like your baby, your kid, like, you don't want to throw it away, but sometimes you gotta change from that. The second thing I would say, great teams or great CEOs is like ability to build a great team around them. So they might be very good at engineering, but if they can find a great marketing person, or they might be great at, the sector, but they find a great tech person. So sometimes that crossover is hard. Some people who I've seen, they're very smart in that sector, but they pick the wrong tech person. Like the tech person, you really should find somebody, preferably, not always, but someone who's worked on a product at scale, someone who's launched a product, someone who's launched product that's, externally usable, preferably in the field you're using. Like if you're doing a consumer product, preferably someone who worked at a consumer tech company. So that kind of ability to hire great people and scale great leadership, I think is another differentiation between, an okay team versus a great team, or okay company versus a great company.
Great. So my next question actually will delve into a little bit more of this deciding how to move a company forward, or what gap we want to fill in the market. So with my first question actually goes to Phillip. You founded and sold many companies. So how do you figure out like what is the right opportunity to pursue, and then what motivates you to keep pushing something forward, or to just say like, okay, we're wrapping it up?
Before I answer that, I want to make one point that Ed made, because I think it's very important on the whole team thing. One thing I would tell folks to not be ashamed of is, if you find somebody that would be great for your team, don't be afraid to be aggressive in pursuing them. I think people are sort of like, kind of afraid to have to like, oh, they don't want to come here, when you should go convince them to come work with you. If you find somebody great, like recruiting is such an essential piece of being an executive, and going out and finding people and convincing them to come join this journey with you is just as important as people, willingly finding a fit to do it. And I think people are hard to find out there. I spent a lot of time convincing someone who may not have wanted to join me or work with me on something, and eventually doing it, and it was the best decision. So in terms of, in my experience, most of the, my first startup, it didn't work very well. I was very young, in my 20s, and I didn't understand the market. And so I guess what I would say is, typically what I see, and even in angel investing, is some type of, and I think Edward kind of touched on this, experience or knowledge that gives you some insight to something else, right? You can see that from anything from like Jessica Alba, who started with diapers because she became a mom and got tired of ordering diapers every week, right? So anything from a life experience in which you understand the consumer, or to in software, you see a problem, you spent a lot of time looking at something and said, hey, there's a better way to do it. So I would really say an idea that comes with something that becomes a bit more practical in terms of whether you can execute on is going to be something in which you've had some experience around seeing or doing and have some insight into how that works and how you're going to make it better. I think that's the first piece. And then the second piece obviously is doing from a product market fit is there an actual market for that is definitely going to be just as important. And that comes from, in my viewpoint of that actually is really just talking to people who know the market. That to me is actually an easier, is when you talk to other smart people like private equity funds that I work with a lot, like do this incredibly well, is they understand these markets. What they can't do is execute how to change or adapt or build something in it, but they do know where all the money is flowing. They do know where all the money goes. And so that becomes easier. So as an entrepreneur, it's like, hey, there's a market here I want to play in. I've got some insight or unique insight, knowledge, skill, something that allows me to go do this, and I can do it faster and better. I think you have a good shot.
My next question goes to Stella. With your company, with WeSolv, what are some of the different considerations you have to continuously make to move the platform forward?
I feel like my job is constantly weighing different options and considerations. I think some of the key ones are always about the ROI on the investments, and that can be the investment of people. So certain salaries and selecting certain people to execute in certain roles. There's considerations for us as a two-sided marketplace that's very mission driven, that's looking to move the needle in a very challenging problem. We're oftentimes weighing our true north, our vision, our mission against maybe easy wins that might be in opposition to what our values are, and knowing when and how to make those decisions appropriately to keep the business moving forward. And to give you an example of that, sometimes we have customers asking for things that they're willing to pay for, but don't actually move the needle or won't actually support their conversion or their engagement with more diverse candidates, better candidates, and actually moving the needle on what the ultimate goal is which is providing access and opportunity for candidates of all backgrounds. So those are just some of them that I have to consider on a daily basis. It's also where to spend my time. I think somebody mentioned earlier that, speed and time is the biggest kind of asset, being able to move quickly, but also time is the biggest or the most constrained resource that we have. And so deciding where and how to use my time is often a really important consideration.
Great. My next question goes to Ed. How do VCs realistically evaluate a company's competitive edge? What is the process like in that?
Yeah, I think competitive edge, there's a couple ways to view it. One is, and this kind of question I learned from this other program called On Deck. One of the VCs there said he usually asks entrepreneurs, how do they view the market differently from the other competitors in this field? So that kind of speaks to, how, why do they think they will win, or what does it take to win? So for instance, like if I give an example, like let's say Dropbox was competing in a very crowded field of file storage, but I think Dropbox had a clear execution and probably vision of just creating something that has very, very good UI. Like they would focus on the UI, like anything that could be like 3 steps instead of 4, they would shrink it and then plus their virality and sharing all that they were able to win even in a crowded space. So I think articulating that clearly, and then you kind of have a gut sense check to see if that really makes sense. Like if what they say is really truly a differentiation versus not. I think that's one thing. The second thing again is awareness about what other players are doing, and then why did they select a certain model? Let's say I talked with an AR company recently, and they're doing something new in AR, but I was like, why, what's your view on what's been successful and what's not been successful in AR? So if they're aware of like why other companies have not succeeded and why companies who have succeeded, like let's say Niantic is one of the better companies in AR. If they say, hey, Niantic was a game, it had a brand, they had a social factor, and it was something you could do every day. So there's something frequent, and they said, hey, that's what we want to do, or just I think awareness of the market and choices is important. The last one I would say would be customers. So especially towards the Series A, maybe not a seed, but towards the Series A, especially the Series B, like, are there customers? Like this, if you are already having customers at the seed stage, and you're acquiring them, profitably, the customer acquisition cost versus LTV makes sense. Then okay, that the customer speaks. I may not know why the customer bought it at the end, but maybe it was the price, maybe it was the service, maybe it was like a specific feature. But I think the customer voice is also important in evaluating companies. So companies who've raised a lot but have no customers, or they say like, oh, we're gonna make that, finally, do this thing to get customers, and they're on their Series C, and it's been a while. Maybe they made a lot of wrong decisions initially, and so that makes me feel less confident in the company.
Thanks. My next question is for Trish. You oversee the Accelerator program. So you're evaluating a lot of different things, not just for the company, but then also the success and their ability to learn and to take advice and feedback. What are your key things that you look for when you're evaluating a startup?
A lot of what we've talked about today, but I think, part of what we've all been leaning into a little bit is also the ability to truly execute efficiently. So even though at times, you might pivot, it might feel like chaos, I think the truth is some of the successful companies we've seen who have had an exit have in fact been able to create a paradigm by which they operate so that there is some day-to-day efficiency and people know what they're doing. And coming from Amazon, I actually think it's a good program they run, which is called Working Backwards. You can Google it. Because they have so many engineers at the company who don't come from the marketing or the product side, is something that they teach early on. But it's basically, your true north, as Stella said, or what's success? And then you work backwards. And it's a way to put the building blocks together in a way that's logical, such that when you do need to pivot or move operationally, it makes sense and it's somewhat efficient. So your burn rate isn't exaggerated and some of those things, because capital is key also at the early stage. And how well you spend it and your gross margins and some of those basic financials that people are going to be looking at are equally key. So, the vision is the product evolutionary, revolutionary. Typically in accelerators, it's evolutionary. And it gets to a lot of those comments that Ed just made in terms of how do you differentiate? Is there really a big enough market for this new evolutionary idea? But then is that founder somebody who can build a team, like Phillip said? Can they operate? Often you have people that are such visionaries, or they like the next silver ball, but they can't operate. So I do think it's important for people to really understand business and at the end of the day, be smart business people.
Great, thank you. Before we change to our advice for those interested in joining a startup, I wanted to see, does anyone else have any thoughts about, when it comes to understanding their business and their market? Yes, Phil.
I would add that, I always try to boil it down to something simple for folks to understand. And, even like, I was mentioning Dropbox. If you can't envision people using your product or service because it's better, it's probably not a good thing, right? Like, it has to be win-win for everybody. Like when Dropbox came out, their big thing was the cloud that was coming was, I want to access my files anywhere. I don't only want it on my PC. I want it in more than one place. That's more efficient. It's like Uber. People didn't think they'd want to, on the fly, order a car. Well, it's more efficient. It's win-win for everybody, right? I'm happy with it because I get a car picked up faster. Somebody has time with their car. Same thing with Airbnb, right? So if you can't imagine, like even in the B2B world, I had a B2B, I worked with big media companies. If you can't simply explain the experience of why your product is actually doing something more efficiently or is better, I think, you know, and then you'd see like everyone's going to want to do that because it's better. Then it sort of makes a bit more sense. And sometimes I think people get lost in either like innovation, like something being cool, like you see that in AR and VR a lot. You know, you see like a lot of stuff where this is just cool, or it's using some cool technology, but they kind of forget the very simple practical thing of, for this to get to scale, you just have to see it as something that it's going to make life better, right? It's a utility or something that's going to actually, people will want it. And it has to be a win-win proposition for everyone involved, whether it's the consumer, the business, the supply chain. Like, you know, when you do disruption, I think those are very difficult, like pieces that people kind of forget. It's like, hey, we're going to screw this part of the, you know, ecosystem or something, but it really does, I think, need to be win-win for almost everybody. I mean, in more efficient models that sort of happens, but that's sort of how I try to simplify. Like, if people can really just think through the problem of what it is they're trying to do and see that this is going to be good for everyone, it's just a better way of doing it.
Awesome, great. So what we have one more area before we go to our Q&A, and I'll open this up to anyone, is, you know, we have some folks that may be interested in just joining a startup company. Maybe they don't have necessarily their idea or something in mind that they want to do for themselves as a founder, but they are interested in being part of a new company and startup. For those interested, what should they be looking for when deciding whether or not to join a startup company to start that experience in their career? Phil, did you want to?
I can start. I mean, I have a great story. When I was younger, to me personally, I think it's all about the team. You know, I just think that I made that mistake very early on, because startups rarely, to Edward's point, end up looking like what it started as. It just doesn't, you know, what you started as initially isn't what is coming. When I was in my 20s, I bet on a small company called Water Cooler with my friend Kevin Chu, and people, you know, are asking, "Oh, how did you make that decision?" It's like, no, I just wanted to work with him. I didn't know that 10 years later he would sell it for $800 million, right? But that's what happened. And, you know, if I look at Gen G Esports, which I also started with him, it really comes down to the people you work with, because as a team, you can solve problems, pivot, make changes, adapt to any environment, and just continually add value in whatever it is, even if the vision's changing, the company's changing, whatever it may be. It's the people that are going to allow you to continue to move forward and build value for your investors, for your customers, whoever. It's not going to be the idea. No one is going to ever, if someone sticks to an idea, it sort of doesn't come to reality on its own. It's still people who are going to make it real. So for me, at very early stages, to me, the most important thing is who you're going to be working with. I think it's different for late stage, you know, Series B, C plus type companies. I think it'd be a little bit of different consideration, but for really early stage, that's what I would focus on the most.
I want to add to that, but I'm going to take probably the softer approach to that. And I agree with all that, but I'm going to add that and just say, I think it's about ethics too. So who are you going to work for, and what are their ethics? I've definitely been in circumstances in my past life where I've walked from things because I felt that they were crossing a personal line for me personally. It would have been financially better for me to have stayed where I was, but I wasn't comfortable in what they were asking me to do. And so I always say, especially to undergrads at UCLA, to have a good sense of who are you? You know, what are your values? What are you in life? Like startups, business, money, it's always going to be there in some capacity. But who are you and what are you really trying to do? And you know, like what Stella's trying to do with her platform, especially given the world that we're living in right now, I think is highly important. And people really need to believe in who they are and step up, and don't be afraid to walk or say no either.
I think that's definitely a segue to the point I was thinking about. I think you really have to look internally at yourself and what you want to get out of that startup experience. Everyone isn't built for startups, and that's not a good or a bad thing. It's just what it is. And so in the early stage, and we're talking about that pre-seed, seed, and, you know, maybe Series A, you have to really be thinking about I'm going to be in an environment where I'm going to be asked to work autonomously, where I'm going to be asked to own things, where I'm going to have to figure really hard things out on my own. Is that the type of experience you want to have? And sometimes it makes sense to go and work at a big corporation, get your feet wet, and then go into a startup. Sometimes it makes sense to go to a startup first and drink from the fire hose and stretch yourself and gain skills that will make you super valuable to either that startup, another startup, or even a large organization. But I think you really need to look internally at yourself and think about, do I and my goals align with this phase of a company?
Yeah, I think building on what Stella mentioned, I think it is important to consider even the stage of the company. Like if you join a growth stage company versus an early stage, seed stage, Series A company, the risks are different. You know, there's a lot of risks, especially pre-seed, seed, even Series A. The company is still defining their product. But you know, Phillip's point about the team, then you kind of have to evaluate it based on the team. You know, could the team have a good track record? Do they have the vision to create the right product and service? Once you get to later stages, you know, depending on what you want, if later stages, the later stage of company, in theory, the company should be more stable. You should be able to see if they have good customers, are they growing well, do they have good leadership, and then the stuff you'll learn at a late stage company is maybe slightly different. Instead of going from 0 to 1, you're kind of building and scaling. So maybe you're going to learn from scaling, you're going to learn from a mentor that gives you more specific skills versus an early stage company where you might be asked to do a lot of stuff and you're really, you know, at the forefront of even some product ideation. So you have to kind of figure out like what you want to learn and have the trade-offs of an early versus late stage opportunity.
Great, thank you so much for that. I want to give as much space for our Q&A because we have a ton of questions. And so it actually seems like we have a lot of really engaged viewers that are watching that are interested in understanding, again, this evaluation piece. And some of our questions are actually very insightful. So I'm going to try our best to get us through it. We have some multiple question people, so but we're going to try to do our best to spread the love. So we have Richmond T, who actually asked, as a VC, how do you evaluate when an idea or concept is being pitched with no clear practice or production yet, versus this concept is being considered fraudulent, like Theranos, that's what he wrote. How can we, as potential employees, partners of these new startups, conduct the same techniques of due diligence that you as VCs employ to ensure that we pick the right startup ideas? Great question, Richmond. Anyone want to?
I think it depends on the startup. If you're talking about a very deep tech startup like bio or like battery technology, then you kind of look at the founding team and did they do research in this area? Like it'd be very hard for someone who's not in the medical field suddenly to find some medical breakthrough, or someone who's not in the material science field to find some kind of, you know, battery lithium, you know, new chemistry breakthrough. So you want to look at the credibility of the team. They work at the right companies, you know, study the right schools, you know, do a PhD or like know this field. But also part of it is also success, like track record of success. If you're doing, you know, if you're doing a SaaS company and the person used to work at, you know, Salesforce, and they're like, hey, I saw this problem at Salesforce, they didn't really solve this problem, that's why I did this, then you kind of know that person has observed or understands the problem and has some know-how to solve it. Or let's say for like, if you're doing fintech and they worked at Plaid or Stripe, you know, then that person has some insight. They're like, well, we were doing it this way, but actually this is where the market's heading. And, you know, internally the company was not going to do this, so I decided to do it. Then you kind of understand their story, but their know-how. So if they can articulate that, why they're doing the company, how they come up with the solution or why they want to do the company, then I think that lends itself to more credibility.
Yeah, my experience, I just leverage a network. I mean, trust is sort of the biggest thing, because with experts, it's just so difficult to, you know, it's like the 10,000 hours, like so many people only spend so much time learning something to become an expert. You've sort of got to get connected to someone you trust to kind of will and has put in that amount of time to know something to tell you that it's valid or it's good or not. And usually nowadays, very different than well, won't date myself back when you didn't have the social networking and smartphones to be able to do it. You know, asking and getting connected to someone even through 4 degrees through trust, you know, you should be able to find somebody who could help you with that.
Thanks. Well, next question is from Tiffany. What are ways in which to evaluate whether to purchase startup equity as an employee? And if so, how much is this? I don't know if anyone has thoughts on this question.
I would just say, as a founder, I don't have experience doing this for another company, but I would say it's how much do you believe in that company, and that's how much. And how much do you believe in yourself? And I say that it depends on the stage of this company, right? If it's super early stage where you will also be an integral member in the success of this company, versus later stage where you have less, than how much you believe in yourself weighs a lot less. But if you believe in that company and that leadership and that team, and also you have the privilege to take that financial risk, we do have to acknowledge that everybody doesn't have the ability to take risks with their capital in that way, then I think those should be some of the important factors that go into your decision. Sorry, that's not a very clear formula. Maybe someone else might have that, but I think those are important things to consider.
In terms of equity, it's really just a tax thing, tax and comp thing, to be honest. In early stages, it's not going to cost you very much. And then later on, it really becomes a tax analysis as to weighing risk to reward upside. So it's really just a mathematical equation, the only variable being how much risk you want to take, and which then offsets taxes. So that will play into that much later on when you do it. And that's, you know, I would probably get advice about that. And there's so many different structures on how to do that.
Thank you very much. Let's another question is from JT. What have you found to be the most predictive factor in identifying a future unicorn? And how do you conduct due diligence to verify whether the founder company meets it?
They're asking for the cheat code.
Mm-hmm. Sounds like it. Maybe there isn't. There isn't a cheat code.
There is one. I mean, the only thing I would add is that there is a reason why a lot of VC funds, and I think Edward and Trish maybe can do that, will back repeat founders. I think that's the only cheat code that I have seen, is that if you've done it once before, you're more likely to do it again. And so if you were to build a team with somebody who's had experience building and wasn't even the main co-founder, or you were the second or third or something and wanted to then be the CEO, something being repetitive, having done it again, is probably the closest cheat code I have seen in terms of more than it is around any of the business aspects or anything like that.
Yeah, I agree with Phillip. Like, I think repeat entrepreneurs, particularly ones that were successful, but I've seen it both ways. Even for one of them, I'm not gonna name which one, but his first startup was not very successful. His second was quite successful. His third is like amazingly successful. I do prefer backing successful repeat entrepreneurs. And even if they weren't the CEO, they were maybe the VP of product, VP of tech. I like, just because they've done a process, they know what the startup, you know, scene and startup grind is about. They know that they need to fundraise. They know the challenges of a startup, you know, hiring and firing and culture. And so they kind of seen the good and the bad, and they kind of can, you know, make adjustments in this new startup. So I think that is helpful, especially when they're doing it in an area that they're familiar with.
Yeah, and I would, you know, put around the people around them, you know, to that. Like, I think my very first startup, I tried to raise money. I maybe did 30 pitches. They all said no. And then when we did Gen G, we went up to do 2 VCs, and in 2 weeks, we had tens of millions of dollars. So, you know, I just think that, like, you know, the experience, you learn a lot in general. And, you know, and I'm not going to lie, like, look, Edward and Trish, having been entrepreneurs, there is kind of a game to it. It's a system. there's a way, that these VCs want to hear certain things and know certain things. And so once you've been through it once and gotten 30 no's, you kind of get better at knowing how to get the yeses. And so I think that's a part of it too. And, talk to someone who's been through that experience.
I actually have a question for Trish. This is from Walter. After you invest in a company, when do you pull the plug and recognize you made a mistake?
We don't have a fund technically. We have proof of concept grants, so we actually partner with people like Ed. So it's probably an Ed, but I can tell you though, by running 3 programs a year, we can totally tell typically within a couple of months which companies are going to be funded by the end of the program and continue to scale and build versus not. And it gets back to a lot of things that have been said on this call, focus, right idea, the ability to kind of get paying customers or drive that LTV. Is there truly a decent market size so that people do want to invest in the company for potential exits down the road? It's a lot of things that people have said here, but you can totally tell based on, in our opinion, we're very early stage, a founder's behavior and how they run their company. Some will go sideways and then they pick up at a certain point. But some in the 6 months, like Ed was just making a comment, like we have a company called UNEST. She was a fully employed MBA actually, so still working, which is even harder. But she was at Capital Groups doing 529 plans, saw the loophole, started building it while she was working, brought employees on part-time while they were working, and then slowly and smartly brought people on. So I think, it also has got to come down to capitalization, right? What is the business model? How much money do you have? Are you burning it to really build something in those 3 to 6 months? Or have you just shot the wad and there's nothing to show for it? So business basics first and foremost. And of course, I'll say that because I'm coming from Anderson. But it's really true. There's got to be some fundamental underlying principles to these companies. And then, what problem are you solving? And again, I do believe, and kudos to Phillip and Stella, it's a lot about the founder at this stage.
I actually have a question here from Brian, it sounds like it's a very technical question. Can you talk about what an ideal board meeting looks like with early stage founders, including prep work versus the actual meeting? It's like a technical question, specific. Ed?
I think a good board meeting talks about the right topics. So a good board meeting, the CEO should be preparing like an overview of all the general big areas like product, sales, marketing, maybe customer, customer numbers, let's say, especially if you're running consumer oriented, even an enterprise, like enterprise SaaS companies have certain metrics that they should be tracking, net retention, cost of a customer acquisition, lifetime value, and just being honest and open and upfront with those things, like what's the good and bad and the ugly of what's going on. I think companies that don't go into the data or they hide the data, you kind of know they're like showing data that's not really core and they're not talking about data that's really important. Like I remember, a number of times there's like companies, you ask them something, but they kind of like, you kind of be like, I think you know what I'm asking for, but you're like not really answering my question. Like then you kind of know they know something's not right and something's not right. Like what's their lifetime value of their customer? They might say, okay, customer acquisition cost is this, but I'm like, if that's true, why don't you scale it up? You're ready to go. Like then this is actually not, that this and that. So I think the right metrics, talking about the right metrics and talking through the good and the bad. If they don't want to bring up the bad, they're not willing to talk about, there's like, oh, this is worth this much. But like, okay, there's a gaming company that was like talking about like how much equivalent ad dollars they were bringing in, but I'm like, they weren't bringing in ad dollars. You're just saying the equivalent of, well, you didn't sell that inventory. So why are they're not really worth ad dollars. So I think there's, being an honest, open discussion to solve problems is important in these board meetings.
Great. We have one more question that we can probably take. And this is an interesting one from Tomer. Based on your experience, what would you do different when you if you were to start your company again? So I don't know, it probably goes to Stella and Phil. And also, Trish and Edward, if you wanted, based on all you've learned, let's say you were to start another company, what would you do differently?
Oh, do you want to start, or I mean, I've done a lot at this. I've done a lot, so I don't really know from my last ones that I would do. I would say I would do differently. I think the biggest thing that I learned from the last lot is um, really knowing how to think through the process of understanding the risk to reward. The other thing that I would really think through is life stage. I think that, your compromise of your time, the sacrifice you have to make, priorities is going to be very, very important. I think that, like when I did that project with China, I was probably working 150-hour weeks. And so, it's not sort of something that's going to be conducive if you have a family with kids and things like that. And so, the one thing I will say, and you appreciate this, I will say very early on is no matter who it is, if you work with them, good or bad, you should treat everyone with respect, because you just never know. I've had people that I've worked with that were like VPs who are now the CEOs of large companies, or who were directors at that time. I've had people who ended up working with me that I met through some other thing that I never even knew. I've had people cold reach out. I just think that treating people with respect in every avenue of what you do, regardless of what level they are, CEO, director, VP, manager, the person giving you coffee, you know what I mean? It doesn't really matter. I just think it's so important as a startup person, because you're in this business, people matter. And I think you got to play the long game, and in the long game over time, it is a very small world. And so that's one thing I would say that I try to encourage people to always keep in mind.
I think that this is hindsight is always 2020, right? That's what they say. I think one thing to remember is that there's no journey that's the same. So there's not really a cheat code, unfortunately, but there are maybe easy buttons to make certain things a lot easier than they have to be. One of those things that I would have done earlier was learn on somebody else's dime. So I probably would have spent time working at an early stage startup, or learning about some of the areas that would be important to building my company before I actually went out to do it. But I only know that now because I'm doing it. The other piece around team, I mentioned being a solo founder. And while I haven't had to go through some of the heartaches that some folks have gone through with their founder troubles and woes, I think having a solid founding team is capital. It's an advantage because you get to go further faster without needing cash. I've been privileged to be building something that I think is very mission focused, and I've been able to get people on board early on when I didn't have cash. But I think having people whose skin was in the game as much as mine from the beginning would have been really nice. And I'm at a very early stage, so Phillip's stage and my stage are very different. And I think my perspective that I'm bringing is more from this earlier, like seed stage startup, as opposed to, successfully exited multiple businesses.
Fantastic. Well, thank you, everybody. We are at time, and there are still so many questions, but we'll do our best to try to see if we can get these questions in front of our panelists and try to get it to our viewers offline. But ultimately, too, the beauty of this kind of program is that we are all part of a Bruin network, UC network, and that a lot of these experiences that all our panelists have shared, truly, sometimes it is having a conversation, connecting with each other, building your network and your just experience to have these times for stories and for insights. Like Stella said, there is no cheat code, but maybe there are easy buttons. And to talk with folks like we have today with all of their experience, they may be able to direct you to some easy buttons to help you along the way as well. So we're so thankful for their time, for their expertise, for their sharing. I'm really also want to thank Alumni Ventures and Westwood Ventures for their partnership in this program, really wanting to build a network of those that are interested in VC and also startups and founding companies. We actually have a fantastic Bruin network. And so, continue to plug into that UCLA network, connect with people like Trish, because they're doing some amazing things as well. And so for those of you that are still here with us, thank you for your time. Thank you for connecting. Stella, Phil, Ed, Trish, thank you for your time today. And again, connect with each other, continue your Bruin network, keep it going strong. And we'll end today by just saying what we say is go Bruins.